Welcome to the Deep Dive. We're here to cut through the noise of corporate earnings calls and get straight to the signals. And today, we're tackling a pretty challenging one, Caesarstone, their Q2 2025 earnings, which dropped pre-market back on August 6th.
Yeah, this engineered stone company, it's really hitting a rough patch. You've got economic headwinds, regulatory changes, major legal issues all converging. So our mission today is really to dig into just how bad the financial misses were and, maybe more importantly, whether management's turnaround plan, this strategic transformation, actually holds water.
Well, the market certainly reacted like the ship was taking on water, that Q2 report. A clear miss against what analysts expected, pretty much across the board. The stock took an immediate hit, and honestly, it kept sliding for weeks. So yeah, the caution around this name, it's definitely justified.
Okay, let's get into those numbers then. What caused that initial shockwave?
Right, well, let's start with revenue. Came in at $101.1 million.
Okay.
Which was quite a bit lower than the consensus estimate. People were expecting closer to $110 million.
Well, that's a sizable miss. It is, and it translates to a pretty steep drop year over year. We're talking 15.6% down on a constant currency basis.
And I imagine that kind of top-line miss just cascades down the P&L, right? Impacting profitability pretty heavily.
Oh, absolutely. It wasn't just missing expectations. It was, a significant deterioration. Take adjusted diluted EPS. The reported number was a loss of netages 33 cents per share.
And negative 33 cents, and the estimate was?
The consensus was looking for a loss of around netages and 17, so almost double the expected loss. Not good.
Yeah.
And you really see the operating leverage pain when you look at adjusted EBITDA. It swung hard into the red, a loss of netages $6.4 million.
Compared to last year?
Compared to a tiny loss, just netages $0.1 million in the same quarter last year. That kind of swing really highlights the deleveraging effect, Costs stay relatively fixed while revenue just falls away.
Okay, so that gap between the revenue drop and the EBITDA loss, that points to some serious issues in the core operations. Let's dig into the gross margin. Why did it compress so much?
Yeah, the adjusted gross margin fell quite a bit, down to 19.7% from 23.8% the year before.
Ouch. What were the main drivers there?
Management highlighted a few key things. First, lower fixed cost absorption. Basically, with lower volumes, their plants aren't running as efficiently.
Makes sense. Less output to spread the fixed costs over.
Exactly. Second was an unfavorable product mix. But the third one, and this is crucial, was pricing.
Pricing. What did they say about that?
Well, the CFO specifically mentioned they had to make pricing adjustments to stay competitive. Prices were actually down 6.5% year over year.
Wait, down 6.5%? That's aggressive.
It really is. That contributed significantly to the revenue decline, obviously. It suggests they're really feeling the heat, maybe fighting off competitors or trying to move inventory fast.
That does raise questions, doesn't it, about the long-term pricing power of their traditional products, especially with all the shifts happening in the market. Can they even get that pricing back?
That is the core tension, I think. And this demand weakness wasn't isolated. It was pretty widespread. U.S. sales, for instance, dropped 17%, mostly tied to the softer housing market, the residential side.
Okay.
Though, interestingly, they did mention their business with Lowe's was actually up double digits, a small bright spot, maybe?
Okay. But the bigger structural shift seems to be Australia, right? With the silica ban.
Absolutely. Australia's sales were down 18.2% on a constant currency basis. That directly reflects the market pivoting away from high silica quartz, which is, Caesarstone's legacy product, because of that government ban that kicked in fully July 1st, 2024.
So that's not just cyclical weakness. That's a fundamental regulatory-driven market change they have to adapt to.
Precisely. It forces a product transition. And then on top of everything else...
Geopolitics?
Yeah. Israel sales were down 21.6%, constant currency, directly linked to the regional conflicts impacting operations and demand there. Just another layer of difficulty.
Man, so with all that pressure pricing, Australia, Israel, how badly are those fixed costs hurting them now? You mentioned the operating leverage.
It's biting hard. Operating expenses, if you exclude some adjustments, climbed to 30.1% of revenue.
Up from
28.2% a year ago. So even if they're controlling absolute dollar spending, which they claim they are, that percentage increase shows how much the lower revenue base is magnifying the cost structure problem. It's operational inefficiency laid bare.
Okay, which leads us neatly into management's big counterpoint. The transformation plan. the cost savings. They spent a lot of time on this during the call trying to shift focus. They announced more savings, right? Another $10 million annualized.
That's right, an additional $10 million, which they expect to start seeing the benefit of in the second half of 2025.
And that brings a total savings program too.
Over $55 million annualized since they started this whole transformation thing back in 2022.
55 million sounds like a big number.
Yeah.
But given the revenue cliff and the margin pressure, is it actually hitting the bottom line? Or is it just offsetting other problems, like shifting production around or dealing with tariffs?
That is the key question, isn't it? Is it real, tangible savings? The proof is in the execution. Management did point to some progress. They said over 70% of production is now shifted to their global manufacturing network, more flexible, they say.
And is that helping margins at all?
Interestingly, yes. They claimed that network shift actually contributed a positive 450 basis points to gross margin year over year.
Okay, so something is working on the cost side.
It seems so. It's partially offsetting those other huge pressures like pricing and volume. So
Right.
there's evidence of self-help, even if it's being somewhat swamped right now by everything else.
And strategically, the plan is basically to pivot away from the old stuff, right?
Exactly. They're pushing hard on expanding their porcelain offerings that's seen as a growth area. And critically, they're racing to develop and launch products with zero crystalline silica.
Which they need to do, especially after the Australia ban.
Absolutely. It's not optional anymore. It's survivable.
They also mentioned asset optimization, selling things off, essentially.
Yeah, trying to free up cash and shrink their footprint. They expect about $3 million in savings from subleasing part of their facility in Israel, the Noyam site.
Okay.
And they also mentioned a potential buyer is doing due diligence on their Richmond Hill site in North America. So moves to streamline and get more flexible financially, too.
Which brings us to the balance sheet. With all these risk-swirling pricing, the transition, litigation, how much cash do they actually have to weather the storm?
That's probably their biggest remaining strength, honestly. They ended Q2 with a solid net cash position, $72.4 million.
Net cash.
Yeah, that's about $75.6 million in cash and short-term deposits versus only $3.2 million in debt. So a healthy cushion.
And they need it, presumably, given the overhangs mentioned on the call, litigation and tariffs.
Exactly. Those are the two big clouds hanging over everything. Let's talk litigation first, the silicosis claims. As of the end of June, there were 423 claims outstanding globally, spread across Israel, Australia, and the U.S.
And how much are they setting aside for that?
They have a provision on the books of $44.9 million for what they estimate is the probable exposure, but they also list an insurance receivable of $25.6 million, offsetting some of that.
Okay, so a net provision of around $20 million currently booked. But the situation is evolving, right? Especially in the U.S.
It is. They had one recent U.S. jury verdict go in their favor, which is positive. But they also mentioned new disputes kicking off in July regarding insurance coverage in the U.S.
Insurance disputes, never good.
No. And maybe the most significant development, the California state courts are now coordinating some aspects of the silicosis cases there.
Coordination, what does that typically mean?
Usually it means things get streamlined. Discovery, maybe how damages are assessed, it can speed things up, potentially leading to faster resolutions or, faster cash outflows if judgments go against them.
So it could reduce uncertainty, but maybe not in a good way for the company.
It's a double-edged sword, definitely. The market's trying to figure out if clarity is good or bad here, how much liability is really baked in.
And then there's the other big cloud, U.S. tariffs. That sounds potentially devastating.
Yeah, this is a big one. Affects the U.S. market, which is roughly half their total revenue.
Half the business. Wow. And the impact.
They estimate the new tariffs, which kicked in August 1st, will have an impact somewhere between 15% and 25% on the products they sell in the U.S.
15 to 25%
Oh.
on half their sales.
Yeah.
That's brutal. How can they possibly absorb that, especially when they're already cutting prices?
It's an incredibly tough spot. Management basically acknowledged they're walking a tightrope. They're looking at pricing actions in the U.S.
Meaning price hikes.
They have to consider it, right? But if they pass on the full tariff cost, they risk losing even more volume and market share, especially if competitors don't follow.
And if they don't pass it on, if they absorb it.
Then their gross margins, which are already under pressure, could absolutely crater. There's really no easy answer for them on this tariff issue.
So summing up the market's view.
Yeah, investors looked at all of this, the Q2 losses, the shrinking revenue, the mounting litigation uncertainty, and these new tariffs, and they focused on the near-term pain. That's why the stock didn't just drop on earnings day. It kept drifting lower, down about 17% in the 7 weeks after the release into mid-September. The pressure is definitely still on.
Okay, well, that seems like the perfect time to pivot to our favorite segment. Put on your imaginary hedge fund fleece, because this is not financial advice. But what's the outrageous, maybe plausible way to think about this situation?
All right. Well, look, the stock's trading near multi-year lows. The market seems to be pricing in a pretty dire outcome, especially on the litigation front. So the key is finding a way to play the uncertainty itself.
Okay, intriguing. What's the angle?
I'd call it a contingent transformation play. It's kind of a long-short idea, but focused on the balance sheet versus the perceived risks.
Contingent transformation. All right, break it down.
The rationale is this. You've got management laser focused on cost cutting, right?
Yeah.
That $55 million plus program. And crucially, you have that solid net cash balance, $72.4 million.
The safety net.
Exactly. The current stock price feels like the market is saying, okay, that's silicosis litigation. It's going to eat up most, if not all, of that cash. Maybe even implies the liability is bigger than what they've provisioned for.
This is the market's assuming the worst on litigation wipes out the cash cushion.
Pretty much. So the trade idea, selling out of the money puts, maybe expiring early next year.
Selling put. So betting the stock won't fall much further, collecting premium for that bet.
Precisely. You're basically saying, I don't think it gets much worse than this from a valuation perspective, given the cash on hand.
Yeah.
The bet is that a combination of things provides a floor.
What things?
One, the structural savings actually flowing through, especially that new $10 million kicking in during the second half of 25. Two, any kind of positive news or even just procedural clarity on the legal front.
Like the California coordination maybe preventing a complete runaway train? Or a favorable insurance ruling?
Right. Anything that suggests the ultimate net liability might not completely overwhelm the balance sheet. You're essentially betting the market has overestimated the net risk relative to that cash buffer and the company's ability to execute on savings.
That's the wild card element, isn't it? Betting that operational improvements plus just enough good news on the legal side stops the downward spiral, leveraging that cash balance as a backstop.
That's the potentially plausible, if definitely risky, angle. You're playing for a re-rating based on reduced tail risks.
Okay, pulling back from the hypothetical trading desk. Let's recap the whole Caesarstone Q2 dive. What are the main takeaways? We saw pretty significant financial misses. Revenue down, profits down, margins squeezed, driven by softer demand, yes, but also some really aggressive pricing pressure.
Yeah, and against that backdrop, you have management pushing this narrative of cost control and strategic transformation. That $55 million savings goal is the headline number they want you focusing on.
But credibility really rests on execution now, doesn't it?
Absolutely. Can they actually hit those savings targets and show them flowing through? Can they gain traction with porcelain and the new zero-silica products? And crucially, how do they navigate the still very murky waters of the silicosis litigation and these new U.S. tariffs?
So things to watch.
Definitely watch for evidence of those cost savings hitting the P&L. Any commentary on demand stabilizing, especially in the U.S. and Australia, would be key. And of course, any updates on the litigation or tariff mitigation strategies.
Right. And maybe one final thought for you, the listener, to chew on. Consider that $72.4 million net cash position. What level of additional silicosis liability, beyond the $45 million they've already provisioned, is the market actually pricing in right now for the stock to be where it is? Calculating that gap, that might give you a sense of just how much pessimism is built in. Something to explore.
Definitely food for thought.
Okay, that's all the time we have for this deep dive into Caesarstone. As always, please remember this discussion is purely for informational purposes. It's definitely not financial or investment advice. Thanks for joining us, and we look forward to digging into the next set of sources you send our way.